One thing I often write about and talk about is the idea that housing markets and cities that have a high share of real estate investors are more vulnerable to a sharp decline in home prices once things start to cool. And they're often more vulnerable because investors, unlike owner occupied homes, are more willing to just sell their properties, list them, and move on than a family, for example. For the investors, just a business decision. They're trying to exit the market before they think prices are going to fall further. Whereas a family is not as eager to just uproot their family and sell their home to try to time the market. Now, we did see this dynamic unfold during the US housing bubble in 2006 and the financial crisis that followed. The states in the US that had the highest share of investors buying homes also had the biggest crash. I mean, they had the biggest rise, but also the biggest crash in house prices once the market turned. And we even saw that to some extent in the Toronto area when at the beginning of COVID, when prices started to cool and the condo market in particular started to cool, we saw a big decline in condo prices, a big decline in condo rents. And an analysis in a report that I did in April 2021 found that the biggest increase in the share of people who were listing their condos for sale actually came from investors rather than end users. So the big question I've been getting recently is, well, why isn't that happening today? Why aren't necessarily investors rushing to sell, adding to the inventory and putting more downward pressure on prices? So today what's happening, we're not seeing a massive acceleration in investors exiting the market for a couple of reasons. The main reason is because we're not seeing as much pessimism. I mean, certainly prices are down a little bit, but investors are optimistic because rents in Toronto are up 20% over last year. And the rental market is very tight. And this is leaving a lot of investors feeling optimistic, that this is a short-term downturn that we're seeing, and prices and rents will continue to accelerate in the future. So, when we think about how housing markets slow down, like at the beginning of the cycle, a lot of the investors who exit because they simply think prices will be lower. So we've kind of passed that point. Prices have dipped a little bit. We're not seeing that behavior right now. But the next thing that might lead to investors exiting the market investors have to exit for financial reasons because they can't really carry the load of debt that they have given much higher interest rates. So what happens in those moments when they go to refinance or renew their mortgage, if their mortgage payment is up 30, 40%, and they just don't have the cash flows to support it, you might see some investors start selling properties. I mean, in particular, ones that are very highly leveraged that have a ton of debt. We haven't seen that on the ground yet. Over the next 6 to 12 months, we might see that, and we don't know to what extent, but I would not be surprised if we start seeing some investors exiting because they can't really carry their properties anymore. And then the other segment, when we think about, the pre-construction investors, many of these investors bought properties 3-4 years ago in the case of pre-construction condos. And we're starting to see many of them trying to assign their units. And an assignment is basically when a condo investor is trying to sell the rights to that contract before they actually take possession. And the reason some of them are trying to sort of exit and flip their contract without taking possession is because some of them probably are having a hard time getting a mortgage today. It's a lot harder today. People, including investors, are getting stress tested, at a 7% mortgage rate. Even private lenders and secondary lenders, which are a little bit more relaxed than banks and more willing to lend at much higher rates, are also making it tougher for investors who are very highly leveraged. So we could see some financial stress among investors who bought, multiple investment properties, pre-construction, don't have the financial means to close on them. But again, these are sort of early signs we're seeing on the ground. At the end of the day, most of the people who bought 4 or 5 years ago, their investment property is probably worth more than what they paid for it. But again, we're going to have to see how this impacts the market, in the next 6 to 12 months. As high rates stay with us a little bit longer, we might start to see more investors, a little bit more distress among investors, and more of them exiting the market in the future. Hope you found that video helpful. If you have any questions, feel free to shoot me an email at askjohn@movesmartly.com.